Jeremy, these are your first full year results as Chief Executive of Savills. You've reported underlying profit before tax of £33 million. Now that's down from £85 million for 2007, but given the state of the market, I imagine you're relatively satisfied with that.
Yes, I think that's a very credible performance. If you think about what the markets were last year, we've had probably 50% value falls in some areas, so to produce profits of 33 million, particularly when you see what some of our competitors have been doing, I think it's a credible performance and one of which I'm proud of as my first year. It's been a very tough and challenging first year and the markets clearly have been deteriorating, but I think to produce a decent profit is a testament to the success of our business model.
One thing to note is that your non-transactional income contributed almost all of your profit. I mean, I guess that's a sign of the times really, or an indication of what's been happening in the market since 2000.
Yes. Well, I mean, partly, clearly, that's because our transactional teams clearly didn't do as well as before. But nevertheless, to have over 90% of our profits coming out of non-transactional is fantastic. And I think that's really a tribute to the strategy that has been going on over the last 2 or 3 years that I've inherited in the last year. We've been going away from the reliance on our transactional income, growing the non-transactional, growing the property management businesses. And as you said, the result is that actually we've done very well out of those businesses. Our consultancy businesses continue to grow. And even as we speak, we're growing our property management businesses. We've got our property management revenues up 34% last year. The trouble is, obviously, it's a lower margin business, so that reflects the profits that are coming down. Nevertheless, it is making profits, and it's good, consistent, recurring income, which our shareholders appreciate.
A word on your UK commercial and residential business for 2008. I mean, I know you've got interests all over the world, but can I start with the UK?
Yes, well, for 2008, residentially, certainly a very, very tough year. When you talk about the cost savings, we said that we did about 22 million of cost savings last year. A large percentage of those cost savings were coming through out of our residential business. Obviously, we have a very large UK business. We've now got over 1,600 people in that business. So clearly the potential to try and reduce some costs there was significant, and we did so. Very tough markets for them. Transactional markets across the UK residentially have been very tough. So that was reflected in their reduced profits. As far as the commercial business is concerned, they made a profit of 15 million last year, which again was a very good profit considering the markets. They were profitable virtually across the business, but obviously their transactional teams had a reduction in profits, but that was made up for, as we said earlier, the property management, the consultancy teams all coming in strong. And certainly looking ahead for 2009, commercial is predicting that all their teams are going to be profitable this year, which again is a testament to the quality of the people there. We are basically maintaining those teams. We've invested in them. We are continuing to invest in teams where we see there's growth, particularly at the consultancy side of the business. And again, on the residential side of the business, we took a lot of costs last year. We closed some offices last year. There's no plans to close any more offices this year. We believe we're getting that business now to a mean and lean state, and where we think we're going to emerge totally a winner when these markets improve.
Do you think in 2009 you'll see any sort of turnaround for the residential business?
Well, it's too early to say just on the basis of 2 months of trading. In January and February are always very quiet months for us. What I can say to you, certainly in London, in February, our applicants were, and our viewings were up 14% on the same period in January. So you're starting to see increased interest. Our actual new applicants registering were 2,000 people in January and February. That's much higher than the end of last year. So we're starting to see a lot of interest in residential property. What we're not yet seeing is this interest being translated into actual deals happening. And of course, we don't have the number of sales on the market that we'd hoped to have. We expected there would probably be more forced sales coming on the market, but of course with mortgage rates coming down, it means the cost of running your mortgage is cheaper, so people aren't so pressed to sell. So you've got a slight mismatch at the moment in the market, and it's the same on the commercial market. You've got a lot of people out there actually keen to buy with cash who think that we're either at or near the bottom, but at the same time you haven't got that many sellers. So what really is going to change is we need confidence coming back in the market where people are prepared to sell because they feel comfortable and where buyers are prepared to buy. And at the moment, we're still waiting for that confidence to come back.
Okay, now the other markets you're active in, the rest of Europe, USA, Asia, very different markets, of course. But can I get a quick word on each of those markets from you?
Yeah. Well, as you say, we are a global player, and whilst the UK is a core market for us, it is only one market. I mean, last year, Asia produced 1/3 of our revenues, so it's a very, very large business for us now, over 150 million of revenue. We've got a very strong Asian business. We are an absolute market leader in Asia, in Hong Kong, Funnily enough, in the investment markets, we did 80% of all transactions. There were 30 million. So we've got a very substantial market share of some of the most valuable markets in Asia. We've got a very strong facilities management business there and a very strong property management business there. So it's a very good, solid business, and I'm confident that even in this year, in 2009, that will make us a good profit this year because they've got those secure income streams. Europe last year made a loss, a small operating loss. Europe for us is a young business. It's only been there 10 years. Most of our competitors have been there 20 to 30 years. So clearly, we don't have the benefit of our brand in Europe. The Savills brand here is a huge benefit to our teams in Europe. People haven't heard of Savills, so it takes time. But we are growing that business. It's still too reliant on transactional. So again, the key there is to try and get away from the reliance on transactional income and focus on non-transactional income. And so we're doing that. And lastly, in the US, we bought a business, Granite, 18 months ago. Clearly, we bought that when markets were very different to what they are today. But on the other, and so therefore, that also made a small operating loss last year. But nevertheless, we are committed to the States. It's an absolute key market. It's a core market. We've got a small team there. We're going to grow that business, but predominantly through recruitment. There are no plans to any further acquisitions there, but we are planning to recruit more people there. Our view is that whenever this recession ends, the US is going to be the first out, and therefore we've got to make sure that we are positioned so that when the capital starts to flow in and out of the US, that we are positioned to take advantage of those capital flows. We are definitely one of the largest global players there is, and for us the US is a very, very important market.
Staff bonuses have been cut by half. You say you've made cost savings of £22 million for 2008, with possibly £20 million more in terms of cost savings coming in 2009. Where will those cost savings come from? Will we be looking at redundancies at all?
Yes, the profile of the cost cuttings going forward is the same as the profile that they were last year. So it's a combination of redundancies, sadly. It's a combination of redundancies, property costs, reducing our property costs, marketing spend, and general incidental expenses. Probably the biggest component of that would be redundancies, and we're looking at redundancies in 2 or 3 of our core businesses. It's still the residential business that is bearing the brunt of the redundancies.
For investors, the full-year ordinary dividend is reduced by half again. How do you justify a cut of 50% to the final dividend?
Well, the cut on the dividend is in fact less than the cut on the profits. The profits were down approximately 60%. The dividend is down 50%. We've taken a prudent view that we should be looking after our shareholders in the same way that we're looking after our profits and our staff. And if staff and bonuses are down 50%, we have to cut the dividend. I think also, secondly, we are very keen to preserve cash at the moment. We are uncertain as to the markets going forward, and therefore we're being very cautious. We want to keep cash. We've got 46 million of cash on our balance sheet at the moment. We've got 80 million of unused credit lines. So we're in quite a strong position, but we want to keep that strength, A, if markets deteriorate, and B, more importantly, if opportunities arise where we can invest some of that cash in the next 12 months, we think we're better off using it in the business than giving it back to the shareholders.
Okay, my very last question. You've already mentioned, or already given me your perspective on how you hope the residential market will perform this year, or how you expect it to perform this year. Just on the UK commercial market, I mean, are you seeing any green shoots of recovery, if I can use that phrase?
Well, I'm avoiding that phrase. What we are definitely seeing, and it's similar to what we're seeing in the residential market, is there's a lot of investors out there with cash now to buy. If you look at commercial property, and particularly if you look at the value of the pound over the last year, the combination of the reduction in sterling and the reduction in values is about 50%. So for an overseas buyer now coming in to buy commercial property, it's 50% cheaper than it was a year ago. We are definitely seeing increased activity from international investors. We're seeing the German funds buying. We ourselves advised the purchaser on the half share of Meadowhall for over 500 million over a month ago. So we're actually starting to see deals happening. The problem, again, is we're not seeing very many forced sales. We're not seeing the banks foreclosing. So there's a shortage of quality stock actually to sell. So you've got a mismatch at the moment between a lot of buyers with cash and very few sellers. But nevertheless, anecdotally, we seem to be getting more than our fair share of the action. So I also said to you that all our departments this year will make a profit. So we think that if we're not at the bottom at the moment, certainly for prime product, we're at or near the bottom, and investors certainly believe there is value in the market today, and they are buying.